On a $300,000 home, most people pay over $200,000 in interest alone. That is not a typo. You borrow $300,000, you pay back $500,000, and almost nobody talks about why. A mortgage is a promise. You walk into a bank, you tell them you want to buy a house, they hand you hundreds of thousands of dollars, and in return, you promise to pay them back, plus interest, every month, for the next 30 years. On the surface, it sounds simple. A house costs $400,000, you put down 20%, you borrow $320,000. At a 6% interest rate over 30 years, your monthly payment comes to about $1,900. You make that payment month after month, and at the end of 30 years, the house is yours. But here's what the bank is actually selling you. It is not just a loan, it is a financial product engineered to maximize the interest you pay, legally, quietly, and in plain sight. The mechanism that makes this work is called amortization, and once you understand it, the way you think about your mortgage will never be the same. Most people assume that when they make a monthly payment, some goes to principal, the actual amount they borrowed, and some goes to interest. And they assume it is roughly split down the middle, maybe 60% principal, 40% interest. That seems fair, right? It is not even close. In the very first month of your mortgage, on that $1,900 payment, approximately $1,500 goes to the bank as interest. Only $400 goes toward your actual loan balance. You made almost $2,000 in payments, and your debt barely moved. By year 5, you have made 60 payments. You have handed the bank over $100,000, but you still owe, check this, $294,000. You have barely scratched the surface. This is not an accident. This is how amortization is designed to work. Lenders calculate your monthly payment so that in the early years, almost all of it covers interest. The principal paydown comes later, much later, when the bank has already collected most of what it wanted. In a standard 30-year mortgage at 6%, here's the brutal math. In the first year, you pay roughly $22,000. $18,000 of that is pure interest. Only $4,000 reduces your debt. In year 15, the midpoint of your loan, you are finally paying more toward principal than interest. But only barely. And by that point, you have already paid over $200,000 to the bank. The financial industry calls this front-loading. Critics call it something less polite. Understanding it is the difference between building real equity and renting money from a bank for 3 decades. Now that you understand amortization, refinancing starts to look very different. Refinancing means replacing your current mortgage with a new one, usually to get a lower interest rate, lower your monthly payment, or both. And on paper, it sounds like an obvious win. If rates drop from 7% to 5%, why would you not lock in the savings? Here's the trap that most homeowners walk into. When you refinance, you reset the amortization clock. You go back to month 1 of a brand new loan, which means you go back to the phase where almost every payment is interest. Say you have been paying your mortgage for 10 years. You have slowly, very slowly started to build real equity. You refinance into a new 30-year loan. Suddenly you have another 30 years of front-loaded interest ahead of you. You lowered your monthly payment, yes, but you may have just handed the bank an extra $100,000 in total interest over the life of the new loan. The math only works in your favor if you stay in the home long enough to recoup the closing costs and break past that front-loaded interest phase. That break-even point is typically 3 to 7 years, depending on the rate difference and your loan balance. So before you refinance, ask this exact question: how many months until I break even? Divide your closing costs by your monthly savings. That number is your break-even timeline. If you plan to sell before that date, refinancing will actually cost you money. Let's talk about where mortgage rates come from, because most borrowers have no idea. Your mortgage rate is not set by your bank. It is heavily influenced by the 10-year Treasury yield, which is the interest rate the US government pays on 10-year bonds. When investors feel uncertain about the economy, they buy bonds, which pushes yields down, and mortgage rates tend to follow. When the economy looks strong, yields rise, and so do rates. But here's what the banks do not advertise. Your personal rate is also shaped by 3 factors you can control. First, your credit score. A score above 760 can unlock rates a full half to 0.75% lower than someone with a 650 score. On a $300,000 loan, that difference can save you over $30,000 in interest. Second, your down payment. The more equity you bring to the table, the lower the risk to the lender, the better your rate. Lenders also use a thing called loan-to-value ratio. Get below 80% and you eliminate private mortgage insurance, saving you another $100 to $200 per month. Third, the loan type. A 15-year mortgage typically carries a lower rate than a 30-year, but you pay dramatically less interest overall and build equity at twice the speed. Rate shopping matters too. Studies show that getting just one additional rate quote saves the average borrower $1,500. Getting 5 quotes can save over $3,000. Here's the part most financial advisors skip over. You don't need to refinance to outsmart your amortization schedule. You just need to understand how principal extra payments work. Every dollar you pay above your required monthly payment goes directly to principal, not to interest, straight off the balance you owe. And because your interest is calculated on the remaining balance, every dollar you overpay today saves you multiple dollars in interest over the life of the loan. The math is almost embarrassing. On a $300,000 30-year mortgage at 6%, adding just $200 per month to your payment cuts your loan term by over 6 years. It saves you more than $80,000 in total interest. $200 a month, 6 years, $80,000. You can also do what is called bi-weekly payments. Instead of making one monthly payment, you make half a payment every 2 weeks. Because there are 52 weeks in a year, you end up making 26 half payments, which equals 13 full monthly payments instead of 12, one extra payment per year. That alone typically shaves 4 to 5 years off a 30-year mortgage. And if you ever receive a windfall, a tax refund, a bonus, an inheritance, throwing it at your mortgage principal can compress decades of amortization in a single moment. Mortgages are the single largest financial decision most people will ever make, and yet most people sign 30-year agreements without understanding what they actually cost. Now you know how amortization front-loads your interest payments. You know how refinancing resets the clock, and exactly when it makes sense. You know what drives your rate, and how to fight for a better one. And you know the simple strategies that can save you tens of thousands of dollars without changing anything about how you live. The bank knows all of this. Now, so do you. If you found this valuable, subscribe to this channel. Every week we break down the financial systems that affect your life. In plain language, with real numbers, no fluff, no sales pitches, just the information you need to make better decisions. The next video goes even deeper into the specific mortgage mistakes that cost homeowners thousands of dollars in the first year alone. You don't want to miss it.